The Financial Conditions Index has shown that financial conditions for businesses and families all over the United States, but also in the Eurozone, remain significantly easier and significantly stronger than what would dictate watching the increase in reference rates. It seems that the banking system is awash with liquidity, and it also seems that there is a perception that interest rates are going to fall rapidly, and therefore that banks are happy to lend even below the reference levels. This is interesting because it shows that the tightening of monetary policy is not being reflected as expected in significant contraction of credit facilities and credit supply to the economy. Of course, there is tightening, and of course, financial conditions are being tighter throughout the economy, but they remain significantly easier and significantly more open than what the increase in rates would dictate. If we look at the change in monetary aggregates, M2, the base money, is basically showing that there is a significant contraction in M2, in what we could call the base money supply. On the other hand, the M3 growth, the broad money supply, looks to be significantly lagging behind the contraction in money supply. So, in general, what we see is that global money supply moves between a $101 trillion and $104 trillion, but not a significant slump. And if we look at it from the perspective of inflation, this might mean that core inflation may remain more persistent than what central banks would like, and certainly what investors would like. We need to look at what is going to happen with the lagging effect of monetary contraction, but certainly so far the persistent levels of core inflation show that monetary aggregates remain ample, and certainly that the tightening of credit conditions is not as aggressive as what we would have expected.